Bruce and Jennifer are cruising through retirement, feeling confident about their savings, only to discover a change in life expectancy is going to dramatically increase their taxes during their lifetimes. This is what I like to call the surviving spouse tax trap. Today, we're going to break down the whiteboard what that is and how you can prepare not only for the expected, but also for the unexpected. So, Bruce and Jennifer, they've been retired comfortably for years now. Actually, they're both 73 currently, and Bruce retired 3 years ago, and Jennifer retired nearly 18 years ago. They're currently now both collecting Social Security, and they've been supplementing their income with taxable distributions from their brokerage account. But now, as many of you know, when you turn 73, that's when you begin taking what are called RMDs, or required minimum distributions. This is going to push their tax liability up just a bit. Well, Bruce initially had a long life expectancy along with Jennifer. To be exact, we were projecting out until age 90. But a recent diagnosis has shortened his life expectancy from 90 down to age 80 at the most. So the question is, how does that impact their tax liability throughout retirement? As you can see, they both have significant assets in this taxable bucket. And that's what they've been using primarily to supplement their income needs over the last several years. But now that they're both 73, as you can see, they have pretty sizable tax deferred accounts. This is a combination of 401ks and IRAs. And when you turn 73, this is the account the IRS cares about. This is the one you're going to have to start to drain down, because ultimately these accounts were being deferred from taxes when you made those contributions initially. And then you can also see there's a small amount in the tax-free bucket. But if you looked at the current plan, and we had both of their longevity assumptions until age 90, like I said, they're currently 73. They're pretty much firmly in this 12% bracket. So they're not in the ultra high income tax bracket at this point in time, and they're comfortable in that 12% bracket. So what's happening right here, the reason their tax bracket goes up to the 22% level right here at 85, is that each year you get older, your life expectancy shortens. And so therefore the IRS calculation in terms of how much you need to take out of your portfolio goes up as a percentage of your account balance. And the assumption here is because they're pretty conservative when it comes to the rate of withdrawal they're taking out of their portfolio. The RMDs, maybe a little bit of distributions from the taxable brokerage account, are pretty comfortable in covering most of their income sources. Once that taxable brokerage account is gone, and once those RMDs begin to go up over time, and also those account balances begin to go up over time with those tax deferred accounts, it does push them up to the 22% bracket at the very end of their retirement. And they're there for about 5 years in the slightly higher tax bracket. But as I mentioned, Bruce has a recent diagnosis, and the expectation is he's not going to live more than 7 years. It's very likely he'll pass away within the next 7 years. And so therefore, the question is, how is that going to impact Jennifer's tax liability looking forward? Well, if you look at the tax brackets here, and you compare the tax brackets on a single taxpayer to that of a married individual, as you can see, it's not very favorable. To fill up that 12% bracket, you need only $48,000 of income, whereas in the married filing jointly, you can earn up to $96,000 and some change in taxable income before being pushed into that 22% bracket. So as you can see, this could be a problem, because even when Bruce dies, Jennifer is going to take over his IRA. So even though he passes, she now owns that IRA, and those RMDs will continue as if Bruce were still alive, because they are the same age. So if you actually fast forward this, you can see, let's say Bruce did make it until 80 years old. Well, at that point, when he passes away, and therefore Jennifer is now going to be filing as a single taxpayer, all of a sudden her tax bracket jumps up to 22% right away at around age 81. Because age 80, that year when Bruce passes away, and this is the assumption there, is she can still file married filing jointly just for that year, and then the following year at age 81, she'll switch over to single, and then she'll be in that 22% bracket, and really throughout. But at the end of the very end, it actually ticks up to about 24% for the last year of her life expectancy. And if she continued to live beyond 90, she'll likely be in that 24% bracket, because those RMDs don't stop just because you turn a certain age. They will continue to increase each year as you get older as a percentage of your account. So if you look at this and you compare hitting that 22% bracket at 80 versus 86. So why don't we look at this graph here, which actually illustrates year by year what the tax liability is. And the orange bar represents tax payments assuming Bruce does pass away at 80 versus the blue bar assumes tax payments assuming longevity. As you can see, both of them are in lockstep up until age 80. And there were some declines and some spikes based on some one-off distributions, as well as based on that taxable brokerage account going down. There are actually fewer dollars coming in from things like interest income and dividends, as well as capital gain distributions. So actually the trend of income for both scenarios goes down until age 80. But after that year, after Bruce does pass away at age 80, now Jennifer is going to be stepping in as a single taxpayer. And as you can see, this orange bar spikes way above that blue and really stays there for quite a while. The reason it catches up a little bit from the blue versus the orange is just because of those RMDs continuing to go up. And then at this point in time, if Bruce did live longer, that taxable brokerage account after 85, let's make that blue, that taxable brokerage account after age 85 goes away completely. So now they're relying solely on those IRA distributions from 86 until age 90. But even so, overall, the net tax outflow for the current scenario, assuming they both lived until 90, from current year from 2025 through 2042, was about $220,000 of lifetime taxes paid, versus the scenario where Bruce passes away early. Jennifer then steps in as a single tax filer starting at age 81 through age 90. Her total tax liability is about $290,000. So it's about a $70,000 increase in lifetime taxes paid, assuming again that that event happened where Bruce did pass away early. Now, obviously, if Bruce were to pass away even earlier, she would then step as a single filer even earlier, and so therefore could continue to widen that gap. No one has a crystal ball. No one knows exactly what life expectancy looks like. But I simply wanted to bring this up because I do see this with the clients that we work with that are surviving spouses, where they are surprised at how much more they're paying in taxes, not just on federal income taxes, but also things on like IRMA surcharges, which is income-related monthly adjustment amount, or taxation on their Social Security, or their capital gains brackets, or even net interest income taxes. There are a lot of these surprising tax liabilities that pop up when you switch over from those joint filer to that single filing status. So things like reviewing that Roth conversion window and analyzing, does it make sense to do conversions, not just with our joint life expectancy, but also if one were to pass away earlier. Again, it's not just about planning for the expected, it's planning for the unexpected. So listen, I'm not saying plan your whole tax plan of retirement to hedge against one spouse unexpectedly dying, but you get the gist. Maybe there is a significant age gap between you and your spouse, or maybe one spouse doesn't have longevity in their favor and the other one does. Once the surviving spouse tax trap kicks in, there's not much you can really do reactively. And listen, we're here to help with this. This is what we help our clients navigate day in and day out for the folks that we serve. And if you're interested in learning more about working with us, you can go to my website at www.imaginefinancialsecurity.com, or you can start with the Retirement Readiness Questionnaire that is linked in the description. I'd love to meet you and see how we can help you to and through retirement. Thanks for tuning in, and see you next week.